Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. With just days to go until the presidential election on November 5th, investors may be worried about how either outcome might affect their portfolios. Investors need to prevent politics from derailing their long-term financial plans. Tax policy is uncertain, especially relating to estate planning. It's important to vote at the ballot, not with our hard-earned savings. How can investors maintain perspective in the weeks to come? It's important to maintain perspective around tax policy, since these issues can be politically heated. While taxes have a direct impact on households and companies, they do not always have a straightforward effect on the overall economy and stock market. Taxes are also quite low by historical standards. This will be true whether the top marginal tax rate is 37% or 39.6%. With the growing federal debt, it's prudent for investors to expect tax rates to eventually rise, whether they do so after this election or not. Planning for this possibility, ideally with the help of a trusted advisor, is only growing in importance. Tariffs were once a major factor in trade and a significant source of revenue for the U.S. government, but in recent decades, they've played a small role. Over the past century, the formation of organizations and agreements, such as the WTO, NAFTA, the USMCA, and others, helped to ease trade barriers across major partners. For investors nervous about a possible trade war, it's important to note that the same fears in 2018 and 2019 did not lead to the worst-case scenarios that some predicted. The economy remained strong during this period, with unemployment near historic lows and inflation non-existent, even though it was quite late in the business cycle. Eventually, ongoing negotiations between key trading partners helped to mitigate some fears. As the accompanying chart shows, throughout different trade regimes, the U.S. has maintained a trade deficit with many countries. The economy has grown under both major parties. When it comes down to it, history shows that the economy has grown under both political parties, and bull markets have occurred regardless of who occupied the White House. Although it may seem counterintuitive, this is because politics often has a small impact on the economy and markets. Specifically, the business cycle and broad trends such as the growth of artificial intelligence and technology advancements, falling inflation, and the strong job market matter far more. Despite the perceived importance of this election, policy changes also tend to be gradual due to checks and balances in our political system. What candidates promise on the campaign trail can differ from what they can actually enact. The bottom line? The election matters for many reasons, but its long-term impact on the stock market and economy is often overestimated. The economy has grown under both political parties, and it's important for investors to maintain perspective this election season. Thank you for listening. For additional information, please visit MRAadvisory.com.